Yeah, Hong Kong Stock Exchange is proposing dual-class share changes to enhance the city's competitiveness and avoid losing blockbuster IPOs such as the one they lost to New York, which was Alibaba. The changes are the biggest since H shares began listing in 1993. Joining us exclusively is the Hong Kong Exchange Chief Executive, Charles Li. How are you, Charles?
Good, good.
What's going on?
Can't be happier.
Yeah. I'm sure you could be. So what's going on? What's been the dominant theme?
Well, I think, this is, as you said, is really the largest change in our listing regime in the last quarter of a century since H share. Essentially, we want to really make sure that now we are welcoming market, for companies in the new economy. There's a reason why many of the new economy companies choose this particular, governance structure.
Why? Because they want the founders want to retain control at the same time. Selling shares. Well, that's the nub of it, isn't it?
Well, but the reason everybody want to control, but historically, you control by investing capital. Now you control by your vision, by your ability to somehow come up with plans to drive the company. Because, a lot of those, founders, by the time they do an IPO, they're already diluted to a very small stake because the whole thing started with a series of rounds of financing. So there's a reason for it. We're not passing judgment to see whether that's the right way of doing it or not. We're simply giving the market the choice.
So who are you hoping to attract in particular looking ahead?
I think we are opening essentially three key elements. One, we're opening a new chapter for biotech companies. Basically, the drugs or product have not yet been approved. So of course they don't have any revenue yet because they don't.
Well, that's it. I mean, this is the thing which some people are pointing to, saying that you're selling out because you're ending this profit requirement for a new IPO.
Well, there's nothing inherent about having to have a profit. We already have a Chapter 18, which is a mining company. There's no dispute, there's value in there, but unless you build a railroad, you will not be able to sell your minerals. So, we do have pre-revenue, pre-profit concept today. Even in the main board today, you're able to list, without a profit as long as you're big enough. But I think in this, new reform, biotech companies, it's a huge value that has been created in that space, and China is a massive healthcare market. So I think we really want to make sure that we open for business for companies that are in the middle of, clinical trials, but yet not receiving approval to be able to list.
So, Charles, that was one of the three that you were talking about.
Yes, second is really waiting voting rights, and, basically dual-class shares. The third is for secondary listing from companies that are already listed in the US or UK.
Okay, now let's move to how this should improve your IPO pipeline. Do you expect me to be talking to you this time next year and saying, well, I've doubled the number of people coming to the big board?
Yeah, I think, we look at it much broader than just, what's the IPO market. Obviously, the IPO market next year is going to be transformative. Next year is going to be fundamentally different from what we have seen before.
Right.
That's great. But in the end, we are trying to connect the market. We're trying to connect our market, the global market, with China's market. We're also connecting Chinese investors to global, products. And I think if we are able to introduce a complete new class of new economy companies, then our market is going to be fundamentally different, coupled with the money coming from the north, the southbound connect, and with the new economy. I think Hong Kong is going to be an explosive growth story for its financial market.
So when people want to come and list, they've got to be, quote, innovative, correct? They're part of the new economy. So how do you define those? I'm sure it's a very complicated process, but in a nutshell.
Yeah, in a nutshell, we're not only saying you have to be at least new economy, meaning that, either technology, intellectual properties, or whatever else. But that's in and of itself is not enough. We are going to publish a guidance letter that essentially trying to figure out why you particularly have to have this kind of a governance structure. So I think new economy as a definition is a necessary condition, but there are a whole lot of other factors we'll be looking at it. But a lot of people really talk about investor protections, and this is going to be a very balanced measure, balancing against this, introduction of new economy, at the same time maintaining sufficient traditional protections for the investor. There is a confusion sometimes people make. We're really talking about two questions. One is how to protect minority investors against potential abuses by controlling investors. The second question is how did the investor acquire that controlling stake. I think by money, historically, or this time by a particular contract. So I think the investor protection never changes a bit.
But it's got to be key if you're going to have keep your reputation intact here.
Oh, reputation absolutely will be intact, because none of the investor protections measures that are in the system that is against the current family-controlled business, for example, are all there. We're not changing anything. The only thing that is changed is that the family-controlled companies acquired that control by money. These people controlled by their original vision, by the investors willing to give them the continued control to grow the company. We want to make sure those controls giving in this particular manner are not perpetual.
Well, you might have a wider gamut of companies then coming on board. Let's face it. Now, the thing is, are you going to be hiring more people to perform the due diligence necessary and not stretch the staff that you have already?
No, they're not different from any other company. The due diligence is not because, as I said, the only difference this company has is the founder acquired the control differently, rather than the business different, rather than we do business differently, rather than we somehow handle diligence differently.
Charles, talking to you a couple of years ago, you were squirming a little bit when we were talking about Stock Connect. You're putting a nice gloss on it, but we knew the truth, that it wasn't really working out. But it seems that 2017, this has come of age, hasn't it?
Yes, I mean, this is a bridge. The bridge, once you build, you need to complete it. But people also need to have something to do on the other side of the bridge. So you really not only need you make sure the lights are there, the access roads are there, the gas stations are there.
And then they see it.
Yeah, they all now see it, so much easier. Now also they feel there's a lot of stuff on the other side that they can go across the bridge to buy.
Both sides?
Both sides, yes. I think obviously initially the north sides, a lot of the stocks in the north side have not been available to anybody for a long, long time. So that's why international investors are going northbound. But now increasingly the southbound.
Southbound is very busy. I mean, it's been taking up allocation quite a few days this year.
Very busy, very busy. One of the reasons that this listing reform we just talked about on dual class shares is to make those shares available to the southbound, because today those shares were still not able to be listed in China.
Why is there still this A share premium over 8 shares?
Well, I think it's going to gradually disappear.
But that's what we say every time. Gradually,
yes, but the issue is we do not allow risk-free arbitrage yet. Short selling into the North, Asia market is still very restricted. So unless you have that sort of a system, so now it's all about buying and switching out rather than a risk-free arbitrage. That is, you buy one, sell the other one, and then you immediately gain the difference. That's not happening yet, simply because of the lack of shorting into the Asian market.
Is that going to change?
Well, over time, yes, but that market is still have a lot of its own issues and challenges and logic, and so I think it's right now it's becoming different choices for people, but it's not an arbitrage too.
Let's look at the Bond Connect as well. That was launched this year. How's that gone for you?
Well, that is also, going very, very healthy.
Much healthily than 2014 when Shanghai.
Correct. Because it's
because people now know. Yeah.
The impact is immediate. But the problem is, but the issue is, bond market is so much bigger globally. So on that sort of a denominator, what we are seeing is only not even the surface. So I think we still have a long, long way to go. At the end of the day, bond market is different. Bond market is not about trading. Bond market is about risk management.
So Charles, you've outlined throughout this interview how you're growing organically. Are there plans to grow inorganically? And that's obviously talking about M&A. What are you looking at? You're not going to tell me, I know, but what are you looking anywhere?
Well, I think, we will only, we have been very consistent that we are not really acquisitive company, but to the extent we do acquire and we do extend.
Well, come on, you bought the LME.
Yeah, we bought LME. That's the only transaction that so far has made sense for us. That is,
are you happy with
China.
it?
Yeah, I'm very happy with it. There's a China clear connectivity with it. And also, they also fill a gap that we have, which is commodities. But I think there's a lot we still need to do and can do to beef up the valuation of LME, by opening up the warehouses, by, getting more Chinese trading.
Charles, last question. Yes or no, will we see Gold Connect in 2018?
Well, we already have 2 golds, London and Hong Kong, and maybe at some point we'll connect them, but not probably in 2018.
Charles, thank you very much indeed.
Thank you.